This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
Welcome to episode 236, and I think, Ben, this is the first time we've taken a dive into this subject. We're looking at the world of investors who have a need to defend themselves against fraud and negligence from the financial services industry. So we had a chance to speak with a lawyer who's based here in Ottawa, and his name is Harold Geller, who we've both known for quite a few years, but you had a chance to meet him, I believe, at a recent conference.
Yeah, we spoke at the same conference last year, and I heard him speak, and he was just excellent. And the premise of the episode is what you said, Cameron. People who need to defend themselves against fraud and negligence, but it was a lot more far-reaching than that. We talked a lot about what people should expect from financial advice, how to know that they're maybe not getting what they should be expecting, what to look for in a financial advisor, what to avoid in a financial advisor. So I think it was a pretty far-reaching discussion. Harold, as you mentioned, is a lawyer who sues financial advisors, as he says in the opening of the conversation. But he's also a very active investor advocate here in Canada. So I thought it was a really powerful conversation right from beginning to end.
And conversation is the key. That's what he kept coming back to. It's all about the communication you have with who's giving you advice, how to ensure you're getting good advice. How can we as advisors communicate better with clients to ensure we are understanding them better and giving them good advice? Due diligence, credentials, naming conventions in the industry. A lot of great practical information from someone who's represented many clients who've gone after advisors. And he also talked about at the end how he's actually turned down representing clients because sometimes people come forward, but they've actually not received negligent advice, which I thought was interesting.
Yeah, he said when he goes through the files of the advisor, sometimes he'll come back and realize, you know what, this was maybe a communication breakdown, but it wasn't necessarily negligent advice based on the client's circumstances.
So Harold's a lawyer at Geller Law, which is a law practice based here in Ottawa. He has a long track record of being involved with the regulators, including being a member of the Ontario Securities Commission's Investor Advisory Panel, the OSC Seniors Expert Advisory Committee, and many number of other appointments in different boards in terms of regulatory bodies.
Yep. Harold's website is gellerlaw.ca if you want to learn more about him. Keep in mind, he's a lawyer in Canada. A lot of the stuff that we talk about pertains to Canadian law, but I think it's broadly applicable.
Absolutely.
I mean, it's just keep in mind, he's a lawyer in Canada dealing with Canadian clients. But 90% of what he said, I think, is broadly applicable, and anybody looking for or receiving financial advice in any form should hear what Harold has to say.
Exactly. And with that, let's go to our conversation with lawyer Harold Geller.
Harold Geller, welcome to the Rational Reminder Podcast.
Good morning. Thank you for inviting me.
Harold, how do you describe the focus of your law practice?
Well, I sue financial advisors. I help people get their money back. Usually it's because of something that's happened in the market, although with insurance policies, it can also be because of the very complex form of investing involved in some insurance policies. So I really help people to understand what happened and then give them advice on whether or not there is good reason to take the complaint further. And if so, I assist them on bringing that complaint in a number of different forums, depending on what's best for them.
Okay, so I want to get more into all of that, but I want to quickly ask if it's related to the market, at least in part. Does that mean last year or I guess the last couple of years were busy for you?
Yes. Well, I'm always a tailing indicator because things happen in the market and then people start asking.
Right.
And then they start calling. So over the last few years, it was more interest rate related. So in particular, insurance policies that were predicted to perform based upon a lower cost and higher returns. More recently, certainly in the last year, we've seen an explosion of crystal ball type cases, people promising better returns or stock picking, and of course, them not performing, doing much worse than the actual markets.
So are those the most typical types of cases you see, Harold?
Yes, I know we'll get into it later, but fraud is actually sort of the tail wagging the dog. The regulators in industry are very concerned about fraud, and I understand why. But it's a very small portion of what we actually see by way of problems. I mean, we're all professionals on this broadcast, and we all give a lot of advice. Any professional is bound to make errors. So even the best are bound to make errors. Now, in something like in investing, where you guys have very high criteria, you have certifications and licensing, but a lot of people out there are dressed up salespeople. And that's they often take one size fits all approaches, chasing returns, making promises to capture clients. And that's the majority of cases that we see.
So you're really seeing advisors that are going out there and promising high returns that they then don't deliver on?
Okay. Yeah, shocking as it is. I mean, to people who are professionals in this industry, they understand what they guarantee is the process, that they will follow a tried and true process. What they can't do is guarantee results. But some of the financial advisors out there are actually guaranteeing results. In a recent case, they were saying, look, we've made 37% year in, year out, and we can double your money within a year. Well, no financial advisor can make that promise with any credibility or any ability to follow through on a consistent basis. So yes, we still see that.
Wow.
Yeah, that's unreal.
It's a bit of a gap.
That's one that's like, in my experience, and for the last 10 years that I've been in this industry, the big compliance thing that you never do is promise a return.
Well, that's right. And it's common sense to those of us who live and breathe in the industry. What's not common sense is for the investors. So many of them are vulnerable, and they're vulnerable for different reasons. They're vulnerable partially because of lack of education in the area, lack of experience, lack of understanding of the industry terms. But it's also vulnerable because, it's an amazing human trait you must see with your clients all the time. People who are somewhat sophisticated in life, but really don't want to bear down on the hard decisions in their finances. Mm-hmm. And so people tend to trust, and they're looking for good news. Why wouldn't they? It's a human trait. And so really what distinguishes the salesperson from the financial advisor who's a professional is that you can't make promises about return. What you can do is help people to understand their situation, understand what their choices are, and as a result, make informed choices. And very importantly, that once they've made the informed choices, they stick to their plan. The knee-jerk reactions of people who recommend things like momentum trading or stock picking often cause more harm than just buying the index. We all know about Buffett's famous bet against anybody who wanted to choose stocks versus him picking 3 ETFs. And over a 10-year period, he won, and his charity got $1 million. That's because even a brilliant investor like Buffett knows that in long-term investment, the best is to make a plan, stick to it, and don't make changes.
Okay, now I think you're probably just touching on this a little bit, but knowing that financial market returns are uncertain, we all know that. How do you draw the line between good advice that got a bad outcome and bad advice?
I come back to the process. If there's a promise of returns, nobody can do that. But people can follow a process. So let's start at the very beginning, onboarding of a client. The term in the industry is KYC, know your client. And often what you see at some of the larger dealers, the more mass producers of financial products, is that they have you fill in something called a new client app. application form, which has a few very basic pieces of information, which the average investor is not able to really make decisions on. For example, how do they compare their risk tolerance to the general population? None of us as individuals can do that. What is average? Nobody knows what average is. So that document is really the tip of the iceberg. And the good financial advisor, good financial advice follows a process which leads to those template or tombstone documents. So let me give you an example of a risk tolerance question. So risk tolerance is, what's your risk tolerance? Low, medium, high, speculative. Well, that doesn't have a lot of meaning to most of us. But a questionnaire which asks us, what do we expect in returns? And later on, or at a different place, ask, are you a conservative investor? Do you want to conserve your principal? Well, if somebody is saying, I want returns of 10%, but are also claiming to be a conservative investor, that's an opportunity within a process. That's an opportunity to both learn more about your client, about these inconsistent wishes, and educate them so that they can become more informed investors. If you're simply doing what used to be like a meat chart and you'd add up the answers and come to a solution of 10 or 20 questions, well, you know that's guaranteed to be a flawed process. And if there is not using that questions to explore further, to get to know the client, then the financial advisor or financial planner is simply not doing their job. That's bad advice.
How about some practical advice for investors? What can they do to make sure that their advisor is actually performing appropriate due diligence on the products that might be recommended?
Oh, so the products, so that's known in the industry as KYP, or know your product. And that's a very difficult thing for most of investors to be able to audit, to double check the work of their advisors. You can ask them for their past recommendations in different years and take a look at how those recommendations performed. But really, if it's stock picking, then it's very difficult. Let me suggest that most of us should not be flying off and doing the newest and hottest thing. An example was a national dealer who allowed their advisor to recommend in large proportions, over 10% of their clients' holdings, a new insurance company that was going to revolutionize the insurance market. Well, that's a pretty high risk trade. And if that's the type of recommendation, something new that's going to overturn a very mature, very moneyed market, then there should be a lot of skepticism. Things like that do occur. Amazon overturned a whole lot of retailing, but it did it over a lot of years. And for many of those years, it was not a conservative pick. It was a high risk long shot, a moonshot. Now, maybe people can have a moonshot within their products, but they should be a small proportion for almost all of us. But coming back to your question, Cameron, it's really, really hard for most clients to be able to check the recommendations of their advisors. Perhaps what you should do is, if you're starting to have questions, go get a second opinion. Go get it from somebody who's a fee-for-service planner or in a different area. Somebody who doesn't have something to sell you is going to be much more objective than somebody whose commission depends on you selling something. And a good example of a commission depending is these exempt market dealers who pay 8 to 10 points on recommendations for sale of some of their products. Well, that's not likely to be an objective advisor recommending those products. That's commission that is completely outstrips those of more conventional products. And face it, follow the money. That's one of the problems within this industry, is the distorted compensation incents the lower end of the market to behave poorly.
Is another
Cameron, I
option?
really don't have a good answer for that, because you can't become an expert in what you're paying somebody because of their training, experience, and education.
I like your comment about following the money and avoiding conflicts of interest. So is another option for due diligence, or at least the process of due diligence analysis, would be to reach out to someone like you?
Yes. Well, I'm better at when there's been a problem for filtering through whether it's a problem which merits a complaint and merits compensation. But on ongoing advice, it's really more people like you. I've looked at your certifications. I've followed your broadcasts. Financial planners and CIMs and the people with a higher level degrees tend to learn professionalism, whereas the entry level courses, for example, to become just a dealing representative, which is the industry title for a stockbroker, or a life agent, which is industry terminology for an insurance salesperson, those are really low qualification hurdles. And as a result, within those qualifications, they're not taught about ethics. They're not taught about conflicts of interest. So let me give you an example of me. I'm a lawyer. I sell my time. So with every client, I have to have a conversation about whether you pay me fee for service or you pay me on results. I have a conflict of interest. I can't talk to you about the terms of my retainer and give you advice about that. I can only explain what I do because I'm a party and I'm interested. Well, that's also true with your financial advisors. Clients should be asking, investors should be asking themselves, have my financial advisors explained how they're getting paid, how that can be a conflict of interest, and made recommendations on how I can inform myself about the decisions. Cameron, I hope I answered your question, although it wasn't a direct answer.
I want to come back to Cameron's question, but I want to ask it slightly differently. So Cameron asked about product due diligence, KYP. I want to ask a similar question on KYC. So we were talking about risk profiling, and you illustrated an education opportunity for an advisor to give to their client through that process. How should a client know whether their advisor is properly performing the KYC process, properly understanding them as a client?
Well, that's also difficult. How much are they asking about your past investments? And it's not just what was your experience, although that's important, right? Because that's a subjective evaluation and might inform things about your objectives and your risk tolerance. But also, what did you do? When did you do it? Did you make money? Did you lose money? How did the experience of making money impact on you? How did the experience of losing money impact on you? If I made you 10% over 2 years, how would that impact you? If you lost 10%, now let's try 20%. These are the types of discussions with Know Your Client that really should go on. Not just good news about how successful a financial advisor is. Also, if the financial advisor is using a whole lot of industry jargon, then you really got to question their skills, because one of the skills is communication. And I think this is true whether you're picking a lawyer or a financial advisor. Pick someone who can explain the concepts to you, who will help you to learn more about the industry terms so you can understand the forms, so you can understand the reporting. If your financial advisor is not sitting down with you when you get your first statement and asking you what you understood and what you didn't understand, what more information you could use, then they're not reporting to you meaningfully. That's another indicator that this whole KYC process, which should be ongoing, is not occurring. And if it only occurs at the beginning or once every couple of years when they have to fill in a mandatory form, they're not really keeping up on you, because we all forget. So you asked about KYC. Well, KYC changes over time. And most of us forget to tell people about KYC changes. Know your client circumstances that change. Well, I mean, there were obvious ones. I'm planning to retire. Well, I'm probably going to tell my financial advisor about that. But if I'm worried about getting my bonus, or I'm worried that I'm taking on another expense because my child got into a university and it's going to cost me more than I'd planned. Those are material changes. And if the financial advisor is not seeking to update themselves regularly about these changes by sitting down and inquiring, then you're not likely to report them. And it's a garbage in, garbage out scenario. They can't give you good advice because they don't know you.
If we were to take a look at the cross section of your clients, are there certain types of investors that are particularly vulnerable to negligent advisors?
It's a real hodgepodge of different people who are vulnerable. So let's start with the extreme. People who are have less certain health, sometimes because of age, sometimes because of other health symptoms, depression, heart problems. It can be diabetes. It can be many things. So they're more vulnerable because their cognition can be impacted. And as a result, when they talk to their financial advisor, might really matter on their understanding of that of that discussion. Let me give you a simple example using myself. I'm a long-term, stay with it sort of guy, but in February 2020, we all remember that period very well. I happened to get extremely ill and was hospitalized for an extended period of time.
Oh, no.
At that time, the market's going through a free fall. I did a knee-jerk investment, and I did a knee-jerk investment because I couldn't tolerate the risk. Now, if we had separated the two events, my illness by a period of time from the markets, I might have felt very differently. So I was vulnerable at that point, although I don't blame my financial advisor. In fact, my tolerance changed at that point for a short period.
Yep.
And I was willing to take a little loss in order to not have the uncertainty over time. So vulnerability can be very much time associated, and elderly are in some ways more vulnerable. Let's take retirees are more vulnerable because they don't have the time, they don't have the ability to make up for losses in their portfolio. So they're more vulnerable. Another type of vulnerability is people under extreme stress. So I think very vulnerable investors include people with marital trouble. If you're having marital trouble and you actually separate, you should immediately be talking to your financial advisor, because your assets are divisible, depending on the asset and the circumstances, but they may be divisible. And if the market drops at that point, you may be responsible for paying for a larger portion than the stock portfolio is presently worth. So that's an example. But let me give you another example, which comes from a different area, one you're less involved with. But often life insurance is sold as a tax deferral process and as an investment. Well, they are interest rate sensitive, and a lot of the products that are sold are actually incredibly complex, very sophisticated, and unsuitable for a long term, even though they're called permitted insurance. So, for example, a universal life policy, and then we get into technical terms, right? Annual renewable term, whatever that means. I mean, I understand it, but most people don't understand the impact. As you get older, if you have a long life, it's all but guaranteed this policy is not going to be permanent. It's going to become unaffordable. So a different type of vulnerability, which is something which is should be sold as a short-term product, less than 10 years, and it sticks around and then blows up when the person no longer has the resources to fund the continued investment. That's a very different types of vulnerability. The way that the regulators tend to look at vulnerability tends to be the frail, the elderly. I don't think that's fair. I think that what we're talking about is a larger rubric, and we all could be vulnerable at different stages. So really is that key that I know you guys believe in, which is continued communication continued learning by the financial advisor and communication by the investor so that everybody can do the best.
What do you think people with aging parents should be on the lookout from their parents' financial advisor?
Okay, well, so number one is the money is the parents. So if the financial advisor is all worried about the next generation and what they want, that's a red flag. That's sales. It's not planning. Now, if your parents are planning that the investments should outlive them, then that's different. That's the parents' objectives.
Right.
Another thing they should be on the lookout for is that the financial needs per year, the expenses of their parents, are projected on a reasonable basis. And while they may decrease in the early years of retirement, for many people, the later years of retirement are likely to get quite expensive. If you're talking about in-home care or supplemental care, that's a very expensive process. And so that should be planned for. One of the things that really all of us as children should be doing is not interfering with their parents' investments, but encouraging them to record information so that we can pick up when they need us to. So where are their bank accounts? What are their bank account numbers? What are their credit cards? I mean, these are some really basic things. How do they pay for different things? For example, life insurance policy. What policies are out there? What payments are required? How are they paid? Where do the notices go? I mean, I know these are really mundane things, but they're really important because if your parent becomes disabled suddenly, which certainly happened to my dad, well, one day he's chair of the Ontario Securities Commission. The next day he can't talk.
Wow.
Well, I mean, that's what happens. And if it hadn't been for his good record keeping, largely kept by my mother, we would not have known where to go, what to look for. So financial advisors, and particularly financial planners, can help with that. And it's a very valuable part of the process. And then looking at the types of investments. Are they relatively resilient to market changes? Are they well-known companies or are they moonshots? There's nothing wrong with your parents deciding that they want to gamble, but it should be after being clearly informed that that's not suitable for them and that there's not recommended for them. And that should be in writing and put to them. If you see things which appear to be moonshots in your parents' portfolio, there's a lot of questions to ask. Doesn't mean there's a wrongdoing, but there's a lot of questions to ask.
Can you talk about how the trusted contact person in Canada fits in there?
Okay, so what we have is a layering of responsibilities. So first of all, you have things like joint accounts. And the idea is that the people are co-owners of the accounts. Now that has some problems sometimes between siblings. So consult with a professional before doing something like that. Now, then you have things like power of attorneys, which can be triggered by the power of attorney when there's a reason. So there's either an agreement that the power of attorney over property is to be exercised. So maybe a parent wants to involve you to have you take over some of their investments. That's can be triggered through a power of attorney. The trusted contact person is really something different. The trusted contact person has no authority. And it was put in place because of sometimes the conflicts between the power of attorney and the parent, but also because sometimes the financial advisors and dealers are picking up that something's not quite right. They're just being surprised with the person's behaviors, their choices, whether it be sending money overseas or gambling or taking out larger amounts of money than it's really explainable. There can be many different reasons why an advisor is questioning what's going on. The trusted contact person should be in place for everybody, regardless of age. And what that is provides the advisor to take a time out to say, I want to call somebody you trust and to ask whether there's anything up. Maybe that trusted contact person knows that you're under stress because your grandchild is ill and you're worried about it. And so you need money, but you're not explaining yourself as well. Maybe it's something very benign, but maybe it's something like, well, actually, I told you about my parents, very sophisticated people. They got a call from the grandchild scam from a Montreal police officer, allegedly, that their grandson had been arrested, needed money. Could they go to Western Union and transfer money? If you got a call about something like that, and the investor needed $10,000, you could take a time out, call the trusted contact person, and the trusted contact person can either talk to the parent and say, what's going on here? Or talk to you and say, perhaps you should know these things, or perhaps there's nothing to do. It depends on the circumstances. But it's really something which is no harm done. Let's check before we take action opportunity. And I recommend it for everyone. And this is different than a power of attorney. I'm jumping in here, but it's different than a power of attorney. It's because maybe it's the power of attorney influencing in a bad way decisions. So it's not common, but that does happen. This is an opportunity, a timeout.
Yeah, it's an interesting role. So this is a tough question. So I'm interested to see how you answer it. We know from empirical research, looking specifically at Canadian financial advisors, that advisors often hold misguided beliefs. I'm sure you know the paper I'm talking about. But they also exert substantial influence over their clients' asset allocations. So from the client's perspective, how do you decide whether or not you should be taking the advice of your advisor?
Some of these questions are very tough, and I don't have the clearest of answers for them. I agree with you that sometimes advisors have pet theories, and pet theories rarely work out. So I've certainly seen gold bugs along the way, or foreign market bugs. I remember going to a seminar about how the European market was going to explode in 2020 and be the best returns. Then something happened. The Ukrainian crisis and price of gas changed. So it's a very difficult. I'm sorry, I lost the question. Please ask it again.
How should a client decide, knowing that financial advisors have these misguided beliefs that are well documented? How does a client decide whether they're going to take the advice of their advisor?
Well, it's partially if they have a pet theory, then that's probably not reliable, and you shouldn't be taking advice. Gold bugs is an example. But there are other reasons. Again, I go back to conflicts of interest. If the advisor is getting paid higher than normal rate of return for a particular investment, well, that distorts the lens through which they see that investment. And so that should be a red flag. There was a very interesting study done by Bronsbury Group and published in 2015 by the Canadian Securities Administrators, which looked at a huge number and percentage of mutual fund trades over, I think, 11-year period. And one of the interesting things which it found was mutual fund advised holdings underperformed the market. And if there was one clear connexus, it was the higher fees paid in most mutual funds. So ETFs are very different. They are very low cost ways of doing very similar things to most mutual funds. So where you can save costs, that is an important element of an important indicator of who to choose. But not all advice should be given by the lowest cost alternative. It depends what you're getting. So, for example, if you're getting a financial plan which is updated regularly and where you're getting real planning intake, how much are you spending? How much are you, how much can that be decreased? What are you saving and how are you deploying it? Are you paying down debt? Because That's a bit of a free lunch. Are you diversified? If you're doing those things through a planning exercise, and that's added value, and it has real value that results in long-term performance.
Yep.
So, well, price is an issue. What is a greater issue is that you have a real plan. And I must take a shot at a lot of the planning that I see out there from the bank associated advisors who do the same plan for everyone. And it's ununderstandable by most of us. You know, it's 50, 100 pages with chart after chart that most people can't understand. And all they do is they drop in the different age, the different amount of assets, a few details about you, and bam, it prints out the same as the next person. That's not planning. It might be called a plan. It's not planning. It's this integration of the interview process, learning about you, keeping up to date, and a plan which looks at things like your savings and how can you reduce your costs. Again, paying down debt is not always in the financial advisor's interest because they might earn less income because there's less assets to manage, but is likely in your interest. It reduces your risk, it reduces your spend, and leads to greater savings. That's part of planning.
So you've referred to moonshots, index funds, fees. What do you think is causing Canada's slow adoption of like low-cost index funds?
Well, partially it's follow the money. As financial planning gets more and more established, those, if they're fee-for-service planners who don't sell funds, who don't sell mutual funds, who aren't compensated for the recommendations, they're likely to recommend suitable ETFs. Now, not all ETFs are after. You can get leveraged ETFs, which are suitable for a very small percentage of very few people. But the broad-based, the XBBs, the XIUs, the market broad indexes should be recommended for most people's portfolios. Why aren't they? Partially because of prejudice. If you're licensed in a particular silo, and that's been a particular problem historically prior to the upcoming merger of the MFDA and IROC, so the mutual fund representatives and the broader based stock brokers. It used to be that a mutual fund a salesman couldn't sell ETFs. Yeah. And so they, even if it was in the client's best interest, lower cost, all that stuff, that's why it wasn't sold, because it wasn't on their shelf. And a lot of the larger dealers, the bank associated dealers, also don't want their advisors selling the ETFs where they're going to make less money. So their shelf contains other products. And we've seen a recent trend where it's only their own in-house products. That's not going to be in the best interest of the client. So they say that they always advise in the best interest of the clients, but really what they're doing, and I think this should be sanctionable by the securities commissions, we'll see if that happens, is they're selling what makes them the most product. How is that reconcilable?
So you mentioned XBB and XIU. So these are ETFs that do not pay trails to advisors. Are you saying there's a lot of advisors still that don't have the machinery to be able to capture fees on client accounts?
Yes. And financial advisors should be paid for their work without doubt. If they're doing their jobs and they're planning, providing you with plans, keeping up to date, helping you to avoid in the meltdown of markets, selling low, things like that, they're earning their dollar and they should be properly compensated. But again, it comes back to the silo that the person's registered in. Mutual funds has been the most obvious, along with life insurance. So a life insurance agent, to take a different example, often aren't licensed to sell ETFs. They're not licensed to sell stocks. They're not licensed to sell reasonably priced products. They're licensed to sell segregated funds. Now, there's nothing wrong with a segregated fund in certain circumstances. If you're about to go bankrupt, if you want to take a long shot and you want the guarantee on the product, then perhaps it's appropriate. But those advisors can't capture the fees of giving you advice that's in your best interest. The model doesn't work.
Right.
Yep. I
I know
remember.
it's shocking, but this is something that has to change. We need a more modern regulatory system. We need something. People don't look for an investment advisor who has a specific license. They look for holistic advice. And the way it is regulated is as if clients have a level of sophistication, which really would make financial advice unnecessary. They wouldn't need the financial advisor if they had that level of sophistication.
I remember when I started in financial services, which is 11, I think, years ago now, or 12, 11, yeah, 12. I started with a mutual funds license, fine. Theoretically, even with a mutual funds license, you could still be a fee-based advisor using low-cost index mutual funds. But where I was at the time, they didn't have the infrastructure to offer fee-based accounts. So you had to sell commission. And I think that part has gotten a little bit better over time, but I just pulled up the data. It's still in Canada, fund assets, mutual funds and ETFs, 66% are still sold in the commission-based or owned in the commission-based advice channel.
And historically, you guys have all watched this debate. The most common form was on a deferred service charge, which are like handcuffs. So you can't change outside of the family if the family's having poor performance, the manager changes or something like that, because if you do, the investor is penalized. So the advisor is incented to keep you with something that could be unperforming, unsuitable for you. And why did they sell that to you? Because it was a big upfront commission. I'm not saying that everybody was doing that for that express purpose, but follow the money. People are incented to make money, and so to advise on products that make them money. And if their dealer only offers certain types of products, so the example is the higher priced mutual funds, often proprietary products branded by the own organization, well, that's a bit of a red flag. Why are you getting that stuff? Okay. I mean, I know you guys have a very different platform where it's not that mutual funds are necessarily bad. It's just that you're not selling your own mutual funds as the only thing for clients' portfolios.
Yeah. Yeah. We've never manufactured products, and that's one of the reasons. How frequently is leverage involved in the cases that you see?
So leverage it tends to have different meanings. So I'm going to use the broader term, not the industry term. Industry term is borrowing within your portfolio or using your portfolio to go to a secondary institution like B2B Trust and borrowing money against it to invest.
Right.
It's similar to within the stockbroker area being margin investing. That's one format. And regulators, even in the insurance area, have put out terribly worded warnings about how this amplifies risks and is unsuitable for many people. If you read the actual signing form as put out by the regulators, it uses industry jargon. It's not an effective warning to most of us. But it's the regulators and industry recognize it's a higher risk activity. There's another format that I see all too frequently, which is borrowing outside of that investment silo, going to a line of credit, taking up money of a mortgage and investing into your portfolio. It's equally risky. It's just a different format of leverage investing. And dealers are less concerned about it because they can't track it very well. But we do find that there are some of the, I'm going to call them the rogue, although they're not necessarily fraudulent or bad people, but really believe in this Smith maneuver and other ways of deferring or avoiding tax. Don't let that tail wag the dog. The question is, debt is a guaranteed expense to you. If you pay down debt, then you're guaranteed return effectively. Okay. So, well, borrowing to invest can make sense in certain circumstances. It's a sophisticated, high risk or higher risk technique, and should only be done with the involvement of a tax planner, somebody who actually has got the skills for the taxation and things like that, who have seen things go wrong and know how to fix it. It's all too common in the self-published self-help books, borrow to invest. And remember that there's a conflict of interest when the advisor recommends borrow to invest, because that means there's more assets under administration, and often they get paid as a percentage of assets under management.
What about in your practice? Do you see leveraged ETFs as being a problem?
Not yet. We're not seeing a lot of cases involving ETFs yet. When will they blow up? When will there be problems? Well, I think that it's predictable because of the incredible complexity and variation that's now available in the ETF market. At one point, it was much closer to a tracking of a index, or closer to a tracking of a subgroup of the index. For example, a dividend aristocrats, term for companies that year in, year out have paid dividends and are large. You can get these, that was the old model of ETFs. They were relatively safe. As more and more opportunities for sales have occurred, more and more ETFs have come onto the market with greater complexity. Crypto ETFs, who knows what the valuation of, if there is any real value in all of that. I know you guys have struggled with the concepts as well on this great broadcast, but that's a type of ETF you can now get. You can get leverage, and you can get things which are very untransparent. You don't know really what's going on in the ETF. I'm expecting that if a financial advisor is involved in recommending those, they're going to end up on my desk sooner or later.
Have you seen cases yet related to crypto?
Not in my particular niche, because most advisors were not recommending crypto as an investment within their portfolio. People were more doing that on the side. But at some point, I'm following advisors who are saying crypto is a gold mine. So sooner or later, it's going to end up on my portfolio. I don't really understand how that falls into a planned investment, other than as a speculative asset. And if it's a portion of speculative, and that's a reasonable portion for that person, then, yeah, we're allowed to gamble at the margins with our own money. There's nothing wrong with that. We just have to be informed and have it within a more reasoned plan.
Yeah, it sounds like it's all about setting expectations, and it's when those expectations are not met is when there's a problem.
Well, that's certainly part of it. Another problem is, I know you'll find this hard to believe, but advisors go dark. When the market goes down, some of them simply aren't available. They're not doing when they're most needed to help reassure that this is part of the plan, and that should be part of the plan, that there's going to be stock market dives from time to time. We know they occur. We don't know when they occur. We don't know what will trigger them, but we know that they occur regularly, more often than once every 10 years, and with very few exceptions. Things blow up, and yes, they absolutely call me. And when they blow up, if that's compared to what was expected or what was explained at the time of the crisis. The largest single reason is lack of suitability. So that can come in many different formats, but that's the largest overriding concern of clients is, how did I end up with this much lodge? How was this okay for my investments? And it's rare that you get somebody calling saying, I didn't make enough money. That's a different sort of thing, which I guess is theoretically possible to pursue a lawsuit for. He promised me 15% returns and I only got 10% returns. I guess that is a type of claim that would be technically viable, but I'd have to say that'd be an interesting case that I don't know about any precedent for. And if you hear a lawyer say that's an interesting case, that means it's on your dime. Take out your pocketbook because it's going to cost you a lot, and the lawyer doesn't know what the outcome's going to be.
We've talked a lot about risky investments and stuff that ends up being maybe riskier than a client thought. Can negligent advice also involve investments that are too conservative?
Well, that's somewhat what I was talking about. And yes, I think that they could conceivably involve that.
Oh, okay.
But what's the argument that the investor is going to say? I was more of a gambler, and enough of my money wasn't gambled. I wanted higher risk.
Yeah.
And he gave me something. She gave me something which was conservative and allowed me to get from point A to point B. Now, we can see circumstances where people are in really bad circumstances. They don't have enough. They don't have enough to meet their goals. And that's a really hard discussion between the advisor and the client. It's one of those times when the advisor really earns their money. And what is the key job of the advisor in those circumstances is tell the client the facts. The advisor is not a miracle worker. It is not a problem of their creation. But the client is entitled, is due to have a straight talk from the advisor saying, here is what I can do. I might be able to get you better returns, but understand that this could mean you have even less money to meet your needs.
Right.
This is a gamble because of where you come to, how you come to me. I don't recommend these gambles, but maybe it's your only choice. You choose. But it comes back to warning of risk, informing the client about their choice. Communication, communication, communication. Benjamin, you said that earlier today. Sounds like a lot of it's about communication. Absolutely key.
On the life insurance side, what types of products do you see most frequently as being negligently sold?
Segregated funds and universal life, particularly on annual renewable term. Segregated funds, they are suitable for some people, but they're often sold because they're the only product the advisor has on his shelf if they're only life licensed. They're high price. The guarantees are rarely going to be exercised. So they're not a panacea, and they're sold sometimes that way. They're also pretty complex products. If you actually read the segregated fund policies, they sometimes don't describe the product. Let me give you an example. We're looking at a segregated fund branded by a bank-associated dealer. When we a life insurer. When we tried to figure out why the performance was the way it was in our client's account, we couldn't account for the numbers. What we found out was that the segregated fund was a proxy for a mutual fund, except that it did not include dividends that were paid out.
Wow.
The policy didn't say that it was returns without dividends. The advisor didn't know it. Frankly, when we cross-examined the insurer, they didn't appear to know. They certainly, there were all sorts of objections saying, well, that's not relevant. Well, yes, it is relevant. It's relevant to the consumer. It's relevant to the performance. So that's an area, and I hope there'll be some class action work in that area. The other one, which I gave you an example for, is universal life, annual renewable term. These are very complex products. They're very sophisticated. They are very cheap in the early years, and they can become extraordinarily expensive. Let me give you an example. We had a client who had some money. They put $4 million into a universal life policy in 1990s. When she's in her late 80s, she gets a bill for $75,000 a month. She didn't have that money. It was supposed to be self-sustaining. It wasn't. These are highly risky products, and they're not suitable. She didn't understand what had been bought. It was in her name. She was a life insured. She was the owner. Nobody explained this risk to her. So that's another type. But a lot of these life insurance policies are actually very complex, and reading them, they are some of the worst written contracts I have ever read. Frankly, if a first-year lawyer brought these contracts to me as an example of their writing, I'd say go back to school. They have defined terms that aren't defined. So when you look at the definitions of the words or phrases used in the policies, they're often not defined, even though they're capitalized within the policy. Looks like people are asleep at the switch.
Wow.
So, well, life insurance can be an important product for people. I suggest that they look at the guarantees that are available, and that they be very well aware that these as investments are extremely complex. They're really for later generations. They're not good financial planning for most people's retirement.
What are some of the things that financial advisors should be doing to make sure that their advice is properly understood by their clients?
Well, it's a human factors issue, and it's complex. Well, so first of all, they should give clients takeaways in plain language. We all walk away from meetings which are not in our area of knowledge or our area of expertise, and we wonder about some of the things that went on. So takeaways are helpful, simple explanations of materials. Using plain language, as I've said, but also a simple trick which I try and use, which is ask the client what they understood. As you go through different segments, ask them what they understood, just to confirm that the communication has been effective. You're not doubting their intelligence. You're making sure that you've been effective in communicating. You're double checking. You're making sure that before you move on to the next concept, the client and you are on the same page. And follow up with them once things have started going into action. So onboarding is learning a lot about the client. What's the client experience in the first 2 months, in the first 6 months, in the first year, in the first couple of years? Checking with them how they're understanding the reports you're giving, the communications. Do they have any questions? One thing I suggest to financial advisors is embed a question at the end of your communications, so the client is triggered to follow up with you in some way. That way you know they've actually read your communication, because we do know that a lot of communications from lawyers or from financial advisors are not read by clients. And if you really want to make sure that you've got the message across, how can you double check it? Well, if you've embedded a question and they followed up with you, check, they must have read to there.
So the opposite of Ben's question, what can investors do to make sure that they understand what the advisor is saying to them?
Break the meeting down into chunks and say, this is what I understood of what you were saying. Have I understood the risks? Have I understood the benefits? Have I understood the options available to me? It's this iteration process of going back and forth where people build learning blocks of communication, because every time you talk to a different person, the communication has different elements to it. Some people are very visual, some people are very oral, some people really can only take in information for a short period of time. Some people want to read in advance of meetings about the concepts. Every professional needs to do some learning about their client and not just do the same thing every time. That in my hand is a hammer, everything looks like a nail, is a real problem for all of us.
So Ontario which is the largest financial services market in Canada, recently moved to regulate the titles of financial planner and financial advisor. And I mean, it's amazing that it took as long as it did for that to happen. Now that it's happened, do you think that Ontario's implementation of title regulation goes far enough to protect consumers?
Well, it's not the implementation which is the Achilles heels of this this new law. It's the legislature. It was a really good proposal. A certain group of financial advisors lobbied against it and watered it down to a broken start. And so FISRA, which is the regulator responsible for rolling it out, is trying their darndest to make something of a bad start. The problem is essentially the credentials, which a financial advisor is called a credential, as is financial planner. These two terms and like terms are now being overseen by organizations that have no history of enforcement against their members, who are conflict of interest. They're not interested in what's good for the consumer. They're motivated by what's good for their members. Their members are financial advisors. So it's not a very good system. The credential is required, so the qualifications themselves have gone to the lowest common denominator. So yes, you have to have some training to be called a financial advisor and some different training to be called a financial planner. But it's almost like collect some box tops, send in a self-addressed envelope, and you get your credentials. Not quite that. Let me give you an example of this. Back when I was young in school, there was grade 13. In grade 13, I was a little bored. So my mother decided I should get some education. And along with going off and becoming a small quantities cook at George Brown, a good course, I became a stockbroker. I had never balanced a checkbook. I had never had a lease. I'd never had a mortgage. I'd never had a real job. But because I had a grade 13 education, I could study hard enough. And the course is basically the same. So the entry level for some of these requirements are so low as to be laughable. And really what we need is a protection so that the people who have done additional studies, who have better credentials, who've studied about conflicts of interest, who have learned about risk tolerance and the challenges of simply a form versus a robust process, that those are the people who are accredited, because I truly believe that to most individuals, it's not their lawyer who's the most important professional they deal with. And it's only their doctor if they have a medical problem that requires attention. It's not their accountants. It's not the engineer who helped build their house. It's their financial advisor who helps make sure the money is there for them when they need it by helping them to plan for it. So these low-level credentials that have been codified by these two titles in Ontario are simply not fit for purpose to protect Ontarians against salespeople. So good idea. Let's hope Saskatchewan does better. There's some real debate about what they're going to do.
So to piggyback on that, what credentials then should the consumer be looking for in an advisor?
Well, I have a bias, and I have a bias towards planning, and that's come through clearly here. And so the minimum standard, I think, for that is a certified financial planner. It's a good course. It's got good ethics. It's got a good oversight auditing program for its members. If a member gets in trouble, they do have an enforcement process. They've used it. There are advanced degrees like the registered financial planners. There are memberships in organizations like the IAFP, the Institute of Advanced Financial Planning, which I know you guys support. You've spoken at their meetings. They are higher level credentials, and frankly, I think that's what we expect of our financial advisors. These people with advanced training. CIM in stockbrokering is an excellent course. There are better courses, but let's face it, the entry level is really basic. And I wouldn't want a doctor with the equivalent level of qualifications ever giving me advice. I want somebody who has had a rigorous study from a rigorous course and has a rigorous process to help me get from point A to point B.
Good answer.
Yeah, it's a great way to describe it. We've touched on some of the bad parts of financial services in Canada. You've mentioned a few times the value of planning and what people can expect or should expect from their financial advisor, how do you articulate the value of good investment and financial planning advice?
Well, I think we just spoke about it. It's that great professionalism, which is not focused on short-term earnings for the financial advisor or even for short-term returns for the investor. It's focused on a holistic approach, looking at the full universe of what's available out there, starting with who is the investor, and then looking at what products would be suitable for them at different stages of their life. How can the investor take better control of their own future by doing things like cutting expenses, cutting debt, increasing saving techniques? One of the simple things that my mother taught me as a child was that if I put regular amount out of my bank account into a separate bank account I didn't look at regularly, I would end up with a whole bunch more money to invest than if I tried to save it within the first bank account. Little tricks which financial planners, financial advisors often know that help people improve their investments and their future financial circumstances really is the hallmark of what I think consumers are looking for, and where, if you think about it from the industry's point of view, where they should be heading, where the individual advisors and planners should be heading, is to these long-term, thoughtful advisory processes and away from the old style, still hanging around, sales is everything processes.
All right, we've just got a couple more questions for you here, Harold. What motivates you to be such a strong investor advocate?
Well, it's a lot of it is because nobody else is standing up and doing it. I don't want to say nobody else. There are some great advocates like Ken Kavinko, Jason Pereira, yourselves for that matter. I mean, this is an important venue for educating investors. This very broadcast. But in speaking to regulators about what the standards should be, industry has lots of influence. There's a revolving door between industry advocates and regulators. They go back and forth between positions quite regularly. And that's to be expected. There is a sort of a lens that goes on the regulators' eyes when they know that good people are in industry and attend good things, that they believe what they're being told by industry, even when it's somewhat self-delusional. It's buying into the system. It's a company perspective. And so there has to be somebody speaking up. Look at the committee membership of the Ontario Securities Commission, or the Investment Industry Regulator of Canada, or the Mutual Fund Dealers Association, or the Financial Services Regulator of Ontario. So I'm talking about Ontario-based regulators in this financial market. You'll see that most committees exclude financial advisors and investors. So how is that proper? How is that in the interest of our community, Ontario, Canada's investment community? It isn't. It is requires people to stand up and speak on behalf of investors. I don't think I am the best spokesman. I'm the one who's available and willing to take the time and do it. And it's very fortunate that I have the ability to spend so much time. A third of my working day is, in effect, advocating for consumers, for changes in regulations, for changes in legislation. Wow. So I do it because it's the right thing to do, and I can fortunately afford to do it. We need a greater community of advocates. We need investors to be involved in explaining what it's like to work with financial advisors, to worry about your future, to bring home to decision makers what your experience really is. And so I do it partially because no one else does it, but I also do it because it's a bit like being Robin Hood. It's a wonderful thing that my training skills and experience have given me, which is ability to help people. But remember, the story of Robin Hood is not selfless. The money was people's. King John takes it. Robin Hood gets it back, but Friar Tuck needs some wine. Big John or Little John needs a staff. Everybody keeps them. I look forward to the day when there's much less work for lawyers like myself and advocates for myself, because investors are more integrated into the regulatory system and protections which are available or should be available to them.
I think you've partially answered this, Harold, but how do you define success in your life?
Well, success in my life is two-part. One is education to regulators, to investors, to our community. And the other part is helping people get their money back. I wish it wasn't necessary, but given that, people will always make mistakes. So that's what I want to see, is just mistakes that happen, human mistakes, helping people recover their lost money. Because when they come to me, they're usually in bad situations. They've trusted somebody, they've followed their advice, and now they've got an unexplained, often loss. So I help them understand what went on, and where suitable, I help them go and get their money back. And I say where suitable with some emphasis, because after reviewing the advisor's files, sometimes I agree with the advisor. I don't think that there was anything wrong done, except that there was a communications break. Okay. And so I actually filter through, and between 2 and 3 or 3 and 4 cases, I turn away because either I don't think there's a wrong, or hiring me as a lawyer would re-victimize, because it costs too much sometimes. And I can't take everything on what's called a contingency, paid when get paid basis.
Wow. All right. Well, Harold, this has been a fantastic conversation. We really appreciate you coming on our podcast.
Well, I'd like to thank you for your investor education. Just focus on that, although there's many things that you provide. This is how people can help take better control of their future, their financial future. And so this is an invaluable assistance to our community. Thank you.
Thanks, Harold. Great to see you.